The Federal Reserve Chair's decisions affect your mortgage rate, your job, and the price of your groceries, yet most people can't name the current chair. Meet Kevin Warsh, the new Fed chair, who took office in May 2026. I'm Sean, and today we're decoding Meet the New Fed Chair, how Kevin Warsh could change your mortgage, savings, and job. Let's get into it. Kevin Warsh was confirmed by the Senate in a 54-45 vote on May 13, 2026, and sworn in on May 22 as the 17th Fed chair. He replaced Jerome Powell, who stayed on the Board of Governors, the first former chair to do so in 75 years. Warsh is a longtime inflation hawk, having served as a Fed governor from 2006 to 2011 during the 2008 financial crisis. The Fed has a dual mandate: maximum employment and stable prices, targeting 2% inflation. Its main tool is the federal funds rate, the interest rate banks charge each other overnight. When the Fed raises this rate, borrowing costs for mortgages, car loans, and credit cards go up, cooling the economy. When it cuts, borrowing gets cheaper, stimulating spending. Warsh is known for favoring a rules-based approach, like the Taylor Rule, which prescribes interest rate changes based on inflation and output. As a Fed governor during the 2008 crisis, Warsh helped craft emergency lending programs that stabilized the financial system. He has long criticized quantitative easing, which ballooned the Fed's balance sheet from $900 billion in 2007 to over $4 trillion by 2014 snots. Now, as chair, he's dropped forward guidance and launched task forces to overhaul the Fed's communications, balance sheet, and inflation frameworks, signaling a hawkish break from the post-crisis era. At his first FOMC meeting in June 2026, Warsh held interest rates steady. But inflation had hit a three-year high of 4.2% in May due to an oil price spike after the Iran war began in late February. 9 of 19 voting members signaled support for rate hikes, a hawkish shift. Warsh says markets perform best when they react to incoming data, not to Fed signals. He declined to submit his own dot plot projection, deliberately keeping policy path uncertain. So what does this mean for you? If you have a variable rate mortgage, any rate hike could increase your monthly payment. Higher rates also make savings accounts more attractive, but they can slow hiring. Warsh has vowed the Fed will remain independent, but his hawkish stance could lead to tighter policy. Some economists warn this could trigger a recession, while others argue it's necessary to curb inflation. The outcome is uncertain. Kevin Warsh was born in April 1970 in Albany, New York. He earned a bachelor's degree in public policy from Stanford in 1992 and a law degree from Harvard in 1995. He spent years at Morgan Stanley working on mergers and acquisitions, then served as an economic policy advisor to President George W. Bush and on the National Economic Council before being appointed to the Federal Reserve Board in 2006 as its youngest ever governor. As a Fed governor during the 2008 financial crisis, Warsh helped design the term auction facility and commercial paper funding facility, injecting liquidity into frozen credit markets. He also advocated for the first stress tests of major banks, a tool now central to financial stability. These emergency programs, credited with preventing a total meltdown, shaped his hawkish view that unconventional tools should be temporary. In January 2026, Trump nominated Warsh, a vocal critic of Powell's loose policy, to succeed him. The Senate confirmed Warsh 54-45 in May, with Democrat John Fetterman crossing party lines. Warsh was sworn in on May 22, becoming the 17th Fed chair. Powell remained on the board, the first former chair to do so in 75 years. Warsh immediately dropped forward guidance and launched task forces to review Fed communications, the balance sheet, and inflation frameworks. In June 2026, Warsh held rates steady as oil shock inflation hit 4.2%. But with 9 FOMC members signaling hikes, a family with a $30,000 variable mortgage could see payments jump hundreds. Small businesses face tighter credit, savers gain higher yields. The trade-off between taming inflation and economic pain is real. Warsh's first moves as chair included dropping forward guidance, a tool Powell used to signal policy. He launched 3 task forces to review Fed communications, the balance sheet, and inflation frameworks. He encouraged FOMC members to submit dot plot projections, but declined to submit his own, signaling a break from Powell-era transparency norms. By mid-2026, the Fed holds rates at 3.50% to 3.75% after its first FOMC meeting under new chair Kevin Warsh. Inflation, driven by a post-Iran war oil shock, sits at a 3-year high of 4.2%. 9 of 19 voting members now favor rate hikes, a hawkish shift from March's forecast of cuts. Warsh has dropped forward guidance, insisting policy will react to data. The July meeting looms as markets brace for possible tightening. Warsh's tenure is just beginning. His rules-based approach and hawkish leanings could reshape monetary policy for years. Whether this leads to a soft landing or recession remains debated. One thing is clear: the era of predictable Fed guidance is over. Investors and households must adapt to a more data-dependent Fed. To sum up, Kevin Warsh is the new Fed chair, confirmed in May 2026. He's an inflation hawk who believes in rules-based policy and has already made changes, dropping forward guidance, launching reviews, and signaling possible rate hikes. How this affects your wallet depends on future decisions. Stay informed, subscribe for more economic insights that matter to you. If you enjoyed this story, subscribe for more deep dives into the people and money shaping our world. See you in the next one.